watching Dukascopy TV. I'm Elaine Stenson and I'm joined in the studio now by Fabio Michienzi, Marketing Director with BCM and Partners Switzerland. He's here with me now to look at fixed incomes. Fabio, you're very welcome.
Thank you very much, Elaine. I'm very happy to be with you today.
So some are saying that it's a mistake for investors to be focusing on fixed income. Would you agree with this?
Elaine, I certainly agree that focusing on a single investment is an error. Nowadays, if we see the monetary situation, we're certainly going through a tightening cycle, but this is happening without a stable improvement in the real economy, which may lead to potential disaster for both equities and fixed income markets. So a careful investor should always balance his portfolio in a mix of different asset classes. And whilst he could participate to the growth story by investing into equities, he will certainly provide good yield to his own portfolio by investing in fixed income. Now, is there a correct mix for any given investor? I wouldn't say so, because this is very much a function of the risk-reward profile of the investor, of his capacity to follow markets, of his liquidity necessity, and at the same time of his asset and liability in his portfolio.
Do you think that US registered bonds, mutual and exchange traded funds may be headed for their worst year of redemptions?
Well, we certainly are living through a bear market situation in fixed income. But data tend to confirm that investors are pouring the same amount into fixed income and equity funds. So I wouldn't say that there is potential for huge redemption this year. What I would say is that the run towards exiting expensive bonds into buying cheap equities has not happened. And this makes me think that we are not facing a secular bear market in fixed income, but rather a market cycle. A market cycle which may change at any time, given the fact that the US cannot stand at the same time tighter fiscal policy and an increase in yields. This may draw back the United States into a lower growth, if not a stagnation phase, where investment in fixed income will be favored again, as we've experienced in the past 5 years at least.
And do you think that this talk of tapering has prompted investors to flee from bond and equity markets?
Well, talking is the right word. I like that, because this has been the biggest success story of the Federal Reserve. Federal Reserve has changed dramatically the way it faces the markets, and instead of acting, the Federal Reserve is first talking the market through their intention, and the market react accordingly. This allows the Federal Reserve not to use all their bullets in its weaponry, but rather to test the markets and adjust their policy accordingly. When we talk about tapering means that the Federal Reserve will slow down its massive repurchase of assets in the markets, and is certainly not the prelude to stopping quantitative easing. Now, tapering has not happened yet, as much as quantitative easing has not happened yet. We see quantitative easing stoppage 2 years ahead at least, but the markets have reacted strongly. Now, where are we heading? We're heading towards a phase where the Federal Reserve will probably delay the quantitative easing stoppage even further, and by doing so will give some breath to the markets to recover.
Okay, and how do you think the situation will progress going forward?
If I had a crystal ball, I would be retired, and probably you would as well. But nevertheless, it is clear that developed economies are going through a different phase, and probably heading towards stagnation, if not recession, some of them. Emerging markets are slowing down dramatically, and on top of this, there is the wild card, potentially very dangerous, of the geopolitical situation in the Middle East. In all of these scenarios, it is clear that we tend to favor a return to fundamentals and a growth story. The growth story for us is paramount in order to justify our kind of investments. And the third quarter of 2015 seems bleak, and we may see a return to in fixed income to a bullish flattening of the yield curve. All of this in an environment without an output gap, a favorable output gap.
Do you think that fixed income products offer better opportunity than betting on equities?
Well, betting is not the best word I would have used, because I'd rather say that any trader certainly needs a lot of stamina to go and do his job properly. But betting is much more a word I would use for a casino-style way of acting, instead of something that you have been thought through. Now, it is also true that I tend to favor fixed income for several reasons. Fixed income I see fixed income as a strategic investment, therefore with a much longer time frame, as opposed to equities, which may be tactical and may be much more short-lived. But again, we go back to the correct mix for every investor in his own portfolio.
Fabio, thank you very much for joining us today.
Thanks to you.
And that's all we have time for now, but do check back later for further updates and interviews from the Dukascopy TV team. Bye for now.